welcome back to the Commodities Institute podcast. I'm your host, Emily Costa, and it is a pleasure to have you with us on this Monday, February 2nd, 2026. If you have been watching the screens today, you know that the word of the day is volatility. We are witnessing what many in the industry are calling a massive air pocket in the markets, a moment where the relentless momentum of the past few weeks has hit a sudden and sharp wall. Today, we are going to dive deep into the dramatic moves in precious metals, the calculated decisions coming out of the oil-producing nations, and some truly unexpected shifts in the global agricultural landscape. Let's start with the story that has everyone on the trading floor talking, and that is the absolute roller coaster we are seeing in gold and silver. Just last Thursday, we were celebrating record highs, with gold futures tapping an intraday peak of $5,626.80 an ounce. It felt like the sky was the limit, but as we have learned many times over my 20 years in this field, what goes up fast can often come down even faster. Today, gold has pulled back significantly, trading closer to $4,677. That is a correction of nearly $1,000 in just a few sessions. Silver has had an even rougher ride, suffering a 31% slump that marks its biggest one-day percentage drop since the early 1980s. Now, you might be wondering what triggered this sudden rush for the exit. It is a combination of factors. First, we have seen a significant rebound in the United States dollar, fueled by the nomination of Kevin Warsh as the next Federal Reserve chair. The market views him as someone who might lean toward a smaller balance sheet and a more cautious approach to monetary easing, which traditionally strengthens the dollar and puts pressure on non-yielding assets like gold. On top of that, the CME Group raised margin requirements on metal futures, moving from 6% to 8% for gold and up to 15% for silver. When margins go up, it forces traders to either put up more cash or unwind their positions, and in a crowded trade, that can lead to a cascade of selling. Despite this carnage, major institutions like Deutsche Bank and JP Morgan are holding firm on their long-term bullish outlooks, with some still forecasting $6,000 an ounce by the end of the year, citing continued demand from central banks and the need for a hedge against ongoing tariff uncertainties. Shifting our focus to the energy sector, the geopolitical temperature remains high even as production levels stay frozen. Over the weekend, the 8 key members of the OPEC Plus alliance, including heavyweights like Saudi Arabia and Russia, met to discuss their path forward. Despite Brent crude closing near $70 a barrel on Friday and hitting 6-month highs earlier in the week, the group agreed to keep oil output unchanged for March. This decision comes at a time of extreme tension, with concerns that the United States could launch a military strike on Iran. Usually such a threat would send prices into the stratosphere, but the market is currently caught in a tug of war. On one side, you have these very real geopolitical risks. On the other, there is a looming supply glut projected for later in 2026 as demand growth moderates and production from non-OPEC countries like Brazil, Guyana, and the United States continues to climb. The alliance is clearly playing a waiting game, offering no forward guidance for the months beyond March. This lack of a clear roadmap suggests that they want to keep every option on the table as they watch how the situation with Iran evolves. We are also seeing interesting shifts in trade flows as India looks to diversify its energy sources. There is talk of the United States pitching Venezuelan crude to Indian refiners as a replacement for Russian oil. India has been a major buyer of Russian barrels, but imports are projected to decline significantly from 1.2 million barrels per day down to perhaps 600,000. This repositioning is a perfect example of how energy policy and geopolitics are becoming increasingly intertwined in this new era of global trade. Now, let's take a turn toward agriculture, specifically to a fascinating trend emerging from China. For years, the story in the Chinese pork market has been one of overcapacity and falling prices for standard white pigs. However, a new premium segment is providing a much-needed lifeline for farmers: the black pig. Often referred to as the Wagyu of pork, these animals are part of a shift toward high-quality, nostalgic food products that Chinese consumers are increasingly willing to pay a premium for. Analysts expect the number of black hogs in China to rise by as much as 50% over the next 2 years, reaching over 30 million animals. While this currently only represents about 5% of the total pig population, the profit margins are significantly higher than traditional pork. It is a classic move toward value over volume, though industry experts warn that if too many producers jump into this niche at once, the premium could quickly evaporate. While China looks toward premium proteins, India is facing a more traditional agricultural crisis. The Weather Office in India has warned of a hotter and drier February following an unusually warm January. This is a critical time for winter-sown crops like wheat, rapeseed and chickpeas. The northwestern wheat-growing regions are expected to receive less than 78% of their average rainfall. High temperatures during the grain development stage can lead to forced maturity, which often results in lower yields and shriveled grains. If the rapeseed crop suffers, we could see India stepping up its imports of cooking oils, which would have a direct impact on palm oil markets in Malaysia and Indonesia, as well as soybean oil prices in South America. We are also seeing a tightening in the global sugar market. Analysts have lowered their surplus forecasts by 800,000 tonnes, bringing the expected surplus down to 2.86 million tonnes. The primary drivers here are reduced production in Brazil and Thailand. In Brazil, many mills are choosing to divert more sugarcane toward ethanol production because sugar prices have been hovering near 5-year lows. Meanwhile, Thailand has been hit by adverse weather that has hampered cane processing. While higher production in Europe has offset some of these losses, the overall trend is toward a tighter balance, which could provide some support for sugar prices in the coming months. Even in the world of feed grains, there is movement. Algeria's state grains agency recently issued an international tender to buy 50,000 metric tons of feed barley. This is a nominal amount, but it highlights the ongoing demand for livestock feed in North Africa. The deadline for offers is tomorrow, and traders will be watching closely to see which origins are most competitive in the current environment. As we wrap up today's analysis, it is clear that the commodities world is in a state of profound transition. We are moving away from the unhindered bullishness of the precious metals rally into a more sober, data-driven environment. We are seeing major producing nations take a defensive stance in energy, and we are witnessing agricultural markets react to both changing consumer tastes and the unpredictable reality of a warming climate. Whether it is the 5% drop in oil prices today or the record-breaking volatility in silver, the message is clear. The path forward will not be linear. The convergence of geopolitical tension, shifts in monetary policy, and environmental challenges means that being a participant in these markets requires more than just looking at a price screen. It requires an understanding of the complex human and natural systems that underpin every barrel of oil and every bushel of wheat. Thank you for joining me today as we navigated these turbulent waters together. If you found this episode valuable, be sure to subscribe, share, and leave a review.